是，我在那个我们那个学会上，没事儿，你有什么事儿，我给你打回去，要不杜老师，OK，哦，OK，OK，要我打回去，OK，好，OK 好，OK，Dr. You can start.
Okay, hello. Can you hear me?
Yeah, we can hear you.
Okay. Hi, good evening, everybody. So Dr. Zhang assigned me this duty task to introduce to our speaker of the night tonight, Michael. Michael is a personal friend of mine, and also he has been working with the dental field for many, many years, and especially with a DSO type of operation. So last time when we have the webinar, I feel a lot of people feel the need to introduce the future DSO, the pressure on all the dental practices. So Dr. Zhang and I, we invite Michael to give us a speech, a talk. So without further ado, let's start the evening lecture. Here's Michael. Thank you, Michael.
Yeah, thank you, Dr. Shui. I really appreciate the warm opening and welcome. And thanks, Dr. Zhang, for giving me the opportunity to present to your mutual audience. I really am looking forward tonight to going over a little bit about what Bannockburn does, as well as how dentists out there, dentists in this group, can dental industry consolidation. I think there's some background noise there. Okay. I'm really excited to talk about navigating the dental industry consolidation, some of the, I think, key focus areas for most dentists to become educated, as well as to open up at the end of this presentation for any questions. Today, our webinar is going to really focus on three main areas, 12 subtopics. Why is consolidation happening is the first main focus area. Second is how can dentists remain and stay independent, and some of the considerations there, as well as if you do want to participate in consolidation, how you may go about doing so. Just to qualify here, when I'm talking about consolidation and using that term, I'm talking about the mergers and acquisitions activity that is currently underway in the dental market space that is really fueled by private equity money to buy dental offices. A little bit about myself. I don't really want to focus on me in the presentation, just so you know a little bit about me. I have held roles both as a COO and CEO at emerging DSOs, one of which was private equity backed. I've had the distinguished capability of growing DSOs from the ground up, negotiating deals with dentists, running de novo operations, as well as acquisitions. My role at Bannockburn, the company I founded, really is to empower dentists by maximizing their growth potential, improving and maximizing their earnings, as well as maximizing their exit value. I have a wonderful project that I'm currently working on as well that I'll be discussing at the end of this presentation that I think everybody will also find very interesting. In terms of very specifics of what Bannockburn does, we do a wide array of things for dentists, DSOs, and institutional platform companies. But to the right, everyone can see some of the bullet pointed services that I provide. It's not limited to that, but just to give you guys, give you all some insight. Everything is focused right now on helping dentists grow by maximizing their operations, increasing patient retention, helping align with marketing resources, goal planning, and other scaling initiatives, with a key focus right now on human capital initiatives. As we all know, having been in the dental industry and seen things progress through COVID, there are significant challenges from a human capital perspective, both from an attraction and retention standpoint. And I have some wonderful tools and partnerships that help me maximize that for dentists. It's definitely key in helping maximize your profitability as well as continue growth into the future. So let's talk about why consolidation is happening. So in terms of dentistry, the business fundamentals are very attractive. Dental practices typically have a greater than 20% profit margin, or EBITDA margin is what you will hear. For those practices that are sort of top tier performers, let's say between 1.5 million and greater in top line revenue, they generally have, those individual practices generally have solid business fundamentals, and they become key acquisition targets for DSOs, even if the DSO isn't backed by private equity. The other reason why consolidation is happening is private equity knows that dentistry is highly fragmented, and this creates an opportunity for arbitrage. You will hear this term used a lot in the presentation. Arbitrage essentially is just exploiting and taking advantage of one price differential from another on, if you're talking about financial markets, it's on one exchange versus another. But in this case, it's really the arbitrage from what you can buy it at to what you can sell it at. The majority of the value driven through consolidation by these private equity companies is growing and growing quickly at mass. That's what drives that arbitrage. Arbitrage. Dentists aren't generally seen as strong business operators, right, in the marketplace. I'm not saying that's the case for all. For a top performing dentist, it's a little bit of a different case, but this allows for private equity institutional buyers, DSOs, to come in and say, we have more effective operating skill, and we can definitely help you focus on essentially what the dentists tend to prefer on, which is their clinical activities as opposed to the business and administrative activities. And this helps create what are called economies of scale. These economies of scale really help increase profitability from a group perspective by allowing centralization to take place where, the private equity firm or DSO itself is able to centralize billing and collections, let's say, or other activities from an operational perspective that drive down the cost to actually operate. So what is private equity and how does it work for those that are unaware? So my definition here is my own that I think clearly and concisely can speak to the audience and be understandable. It's really a collection of finance and operational professionals. Some have spent time in private equity, some haven't. But the firm is put together of these general partners that are mostly finance professionals, generally less operations capable, who raise equity and debt through an investment fund in order to acquire businesses, in this case, dental companies, dental businesses. And these are commonly referred to as a platform company. Private equity's aim really, again, is to achieve that arbitrage through fast inorganic growth by creating a spread between what they're purchasing at and what they're selling at. The main aim of private equity really is to achieve a strong return for its limited partners. And I have a slide that kind of describes this at a very high level to everyone. By utilizing that formula of debt and equity, by creatively structuring the acquisitions. This doesn't mean, however, that there's no upside for the business principals, in this case in dentistry, for the dentists that own the business. In many cases, there is upside that's offered as a part of the deal, but it really depends on the deal. So if you're working with a well-formed private equity firm and DSO, they're going to want to share in those profits, with the dentist. And I won't touch on the shared service because I did hit on that in an earlier slide, but their main aim, again, is to drive those operating costs down at the platform company in order to drive profitability up. That's the main game of private equity. This slide, I just wanted to provide some high level for everybody. Most private equity firms will exit in about 3 to 5 years. Now, there's a reason why you will hear in the marketplace that private equity wants to exit in 3 to 5 years. And that largely has to do with what multiple on invested capital they can actually achieve for their investors, and what internal rate of return they can achieve in their portfolio. There's a lot that goes into this. The numbers are really less important, but if you see in the red ovals, you can see that by the time you get to your 4th or 5th year in the platform, you're achieving a really good, solid multiple on invested capital and internal rate of return. That typically guides the exit. But this return on capital timeline to investors is also what dictates when the firm has to get out. So there are some firms that they'll hold a platform company for about 10 years. Some will only hold it for 5 years, but it really depends on what that return of capital timeline promise of the investor is. So really the key focus of this slide is to focus on, hey, from the private equities side of things, their goal is grow fast, achieve a good multiple of invested capital and a good internal rate of return on the portfolio. That just doesn't just benefit them and their limited partners, their investors, but it benefits the dentist as well. The next question is, why are private equity backed DSOs growing stronger? So, private equity is always looking for, the next opportunity in any given sector, right? But about 7 years ago in dental, there was a much heavier inflow of capital. You will hear this term dry powder being thrown around. A lot of allocation of dry powder and capital into the DSO space, into the dental space. And we started seeing more DSOs pop up. And we also saw some relatively new DSOs really grow very, very fast once they got acquired by a private equity firm. Dentistry, the reason why is because dentistry is a recession-proof business. It's seen as a model that has steady growth year over year and is generally attractive to private equity firms. Since dentists, again, don't typically like to focus on business management and see it as a distraction, they want to focus on clinical, the DSOs are able to come in and promise to take that distraction and activity off of their plate and preserve business continuity while also providing a pretty significant upside for the dentist, either via a cash payout or equity consideration. For a lot of dentists, one of the main reasons why DSOs have been growing stronger is a lot of them want to get rid of their debt-heavy situation. A lot of dentists, this may not be true for everybody on today's presentation, but a lot of dentists are in a predicament where they have a lot of student loan debt, or they have a lot of practice debt, or other debts, frankly, that they want to use their practice as a tool to wipe that debt out and take cash off of the table. So those are some of the reasons why private equity-backed DSOs are growing stronger and faster. So here's a question that I know would be asked of me in my practice, and that is, how do private equity firms and DSOs really negotiate their deals, and what's in it for the dentist? So typically a private equity firm or DSO buyer will provide, and I do distinguish between the private equity firm and the DSO, because sometimes the private equity firm is the one directly making the offer, or the DSO is the one making the offer. So it's important to distinguish here. But typically the PE firm or DSO will offer offer a purchase price based on EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This is essentially a normalized cash flow for the business. There's not usually a lot via depreciation, in a dental practice. So really, you'll see EBITDA and net operating income come in pretty close. Most DSOs will follow two basic structures. One is typically a full purchase, and there's usually a holdback associated with that purchase. And the second structure is a partnership, or sometimes commonly referred to as a joint venture. what is becoming more popular in today's marketplace, as opposed to, let's say, a heavy hitter and a long-term player like a Heartland Dental, which I'm sure everybody on this call is familiar with their name, is the partnership model. The partnership model is taking off like wildfire and is extremely popular among the dentists, because a lot of these dentists who are selling out are typically on the younger side of the age spectrum and have more time to practice, and the partnership affords them the opportunity to stay on and work. The dentist typically is able to take cash value out of the practice up to a certain percentage, and then have the ability to recapitalize on their equity positions, sometimes multiple times. So a good example of this is, let's say I'm a dentist who is 45 or 50 years old, and I've got another 20 years of practice left in me, and my private equity firm is, going to recapitalize every 7 years. If I leave all or a portion of that equity in each additional recap, the multiple effect that takes place every time the DSO gets sold, and let me clarify, when I'm saying recapitalize, that's when essentially and effectively the DSO gets sold again to a new private equity sponsor. That equity position for the dentist is very, very attractive. But there's a lot that goes into selecting them. So another question I get as a follow-on to now understanding how the private equity firms make their money and some of the considerations is, well, how much time do I have as a individual practice owner until that competition in the marketplace becomes too strong to compete? This is a question I know Dr. Shui had brought to my attention and said was a concern among his other fellow dentists, and is a concern, frankly, of a lot of dentists that I speak to. The choice essentially to remain independent is definitely yours. No one can force you to sell, and there's no point really to worry unless you're really presented with a problem. However, over the next 5 to 7 years, things will become considerably more difficult on individual practice owners from a competition standpoint. Market share will be controlled by fewer and fewer DSOs, because at the top, even those will consolidate eventually. And I would say that in light of that, a plan for top performing dentists should have a clear strategy over the next 2 to 5 years to maximize your practice
Hello,
value.
Michael, we lost you.
Can you hear me? Dr. Shui,
Yeah.
can you hear me now?
We can hear.
Oh, we're good.
Okay. Sorry about that. I think I was talking about a plan for top performing dentists. So if you are a dentist that's, doing over $1 million in revenue and you're a top performer, you should absolutely have a clear strategy of what you want to do over the next 2 to 5 years in order to maximize your practice's value, even if just for optionality purposes. There are going to be high opportunity costs, but you need to have plans and goals in place to be able to compete with the competition. So how can you stay independent? In light of it becoming more challenging over the next 5 to 7 years, and in light of the fact that private equity-backed DSOs will have more competitive pricing for new patients, their marketing will be more effective at attracting new patients, and generally they will operate more profitably. You can absolutely remain independent, but you probably will have to accept that attracting those new patients will be more difficult and profitability will be lower. I would say that rural practices will last longer as successful independent ventures versus urban and suburban ones, because they are less targeted by DSOs because of the difficulty to operate and source human capital. One thing I would say, if you're going to remain independent, that's not on this slide and is worth mentioning, is just like a Fortune 100 company would, in conjunction with a top 4 consulting firm like an Ernst & Young or BCG or one of those, you need to start looking at really creative ways to offshore and outsource processes and reduce your technology costs. and negotiate more competitively with your vendors to stay independent. And I just touched on some of that a little ahead of time, so I'll burn through this slide. But so to touch on what you need to do to compete, you need to be able to create better optimized marketing. You need to be more effective in your protocols to retain new patients. This is key. You need to be much stronger on your treatment planning protocols and acceptance rates, because, you know, with other DSOs controlling pricing the way that they are and driving that pricing down, if you happen to be more expensive, you've got to be able to develop better trust and acceptance rates. You have to be able to expedite your visits and have more availability open on your appointment book. And this is really key. You've got to be generous on associate attraction, retention, and compensation strategies. I speak to dentists all the time about this. Each practice is different. You've got to retain your associates. And there are ways of doing this without breaking the bank. You also need to be able to create attractive workplace cultures. I would say the generous associate attraction, retention, and compensation strategies, as well as the workplace cultures, are probably the two most important on this entire list. I should have bolded them and put them at the top. And there are ways to analyze and address workplace culture that other companies do that dentistry doesn't, that can really set you apart from your competition to be competitive as consolidation continues, because they are going to be targeting your people to come work for them. I touched on this, but I'll say that, does staying independent really mean lower profitability? I think that it does, but you're going to have to deploy some effective employee engagement programs. You're going to have to attract your patients more effectively, and you're going to have to negotiate your fees in network more competitively. You're never going to be able to do it as well as some of the big guys out there, like a Smile Brands as an example, but you've got to focus on doing whatever you can to maximize the profitability that likely will drop over the next 3 to 5 years. I touched on employees, saying that that was the most important, one of the most important. So what strategies do you guys have, do you doctors have to keep your employees? DSOs are going to get better at this element year over year. And in order to compete with them, you've got to come up with good benefits programs. You've got to customize your compensation systems, especially with your associates, as I mentioned. Equity and long-term incentive plans need to be in place. That's the L tip that I have there. You've got to drive cultural alignment in your practice. You've got to engage your employees. And leadership and management needs to be optimized. As a dentist and as a doctor, you've got to be able to not just drive respect, but you've got to be able to command it. And I'm not implying that anyone on this call is incapable of that, but I've spoken to executives in other industries and many dentists where this is definitely important, definitely an important key focus to remain competitive and to keep your employees. If you're planning to retire, but you don't want to sell, the real question is, are there any non-traditional strategies to keep your practice more than 10 years? This is something that I have really tried to spearhead as a part of my advisory business, consulting. There is a unique way. It's a way for a dentist who may have a high opportunity cost at selling, and they might be 60 or 65, and they only have a couple of years left. They haven't planned 3 to 5 years out. You know, your options are typically, right? You can sell to an associate and walk away. You can partner with an associate. You can sell to a DSO, or the unique strategy that you can use is you can annuitize your dental practice. And this is a very unique strategy. It doesn't work for every dental office. There's a model and a system you have to meet, and you have to work in conjunction with a good advisor to do this. But I've created what's called a dental annuity, and this is not a plug-in for me, but it is a way for those out there who want to compete against the DSOs, still remain independent, but also be creative and more profitable with their retirement. And it's an option that allows you to hire a firm to administer the entire retirement process, utilizing your practice to collect free cash flows off of your practice, administer that practice appropriately, and provide you with semi-annual reviews. It's a great, what I call hold and sell option, meaning you hold for a specified period of time, and then you can sell at a very good value. And typically when we run the financial projections on this, if the dentist actually fits the mold, if the practice fits the mold, it creates a much better value for the business over a greater than 10-year period. And by the way, at the open of this presentation, I should have said that when I'm finished presenting, definitely happy to answer any questions that anybody has. Now here's to conclude on the third topic. How can I participate in consolidation? Well, my argument is participating in consolidation is not a bad thing. It isn't always quote unquote selling out. There are always various options available to dentists. But the key is making the right decision and being armed with the right information in order to make that decision. Your decision to affiliate or partner or sell outright must be given a lot of thought. But there are a lot of ways to negotiate and craft deals that keep the dentist, the selling dentist, in control. And there are some buyers out there that don't want you to relinquish a lot of control. So the market is really saturated with DSOs that are very different. And a good advisor is able to tell you, good counsel should be able to tell you how to properly weed through those options. But some of the deal points you typically want to be focused on if you're going to participate in consolidation is, one, what is the structure of the deal? What are the total deal incentives? How much cash am I as a dentist getting versus equity? Is it better to have 80% cash and 20% equity, or is it better to have 60% cash and 40% equity? It all really depends. Depends on the firm you're dealing with, depends on what your goals are. You know, what is the equity participation rate at recapitalization? What is my time frame? And most important, what are the DSO's operating philosophies, vision, and what are their leadership backgrounds, as well as what is the equity sponsor and PE's background? Those cannot be missed, especially if you're an early stage DSO. So what are your exit planning options? And if you can't beat them, quote unquote, join them, as everyone knows, right? What are those options for you? Well, again, if you're a practice that's over $1 million in revenue, a DSO is going to be interested in having a conversation with you. Larger DSOs with a far more established track record may look for something called a tuck-in. Tuck-ins, which means if you're at about $750,000 in revenue and they can fit you into, you know, it's not really a merger per se, right? But they're just kind of adding you for market share. They may look at you at around $750,000, but really you're a DSO option at about a $1 million in revenue number. Planning an exit to a DSO or even a traditional exit to another doctor should be done with at least 5 years of practicing left. The reason why I say even with a traditional exit is because that at least gives you time to prepare. But for most DSOs, the firm commitment in their model is going to be 5 years of practicing as a doctor. The ones at least that have a good partnership model and you want to join them. Many of these models offer very attractive purchase prices and equity schemes that can get you significantly higher value for your practice versus a private sale. And I've got a slide here I'll go into here in a second that explains all of that. If you're a general practice office with specialty in-house, you get offered a much higher number. If you're an office with multiple associates, your offer will be much higher. And practice owners should always know at any given period of time, if they're planning on an exit, is what is your practice value? What are those value drivers? What are your exit options? And what is your retirement time horizon? So what are the purchase structures, as I alluded to on the previous slide, for the selling dentist? So you could sell it 100% to an associate. I think most of the dentists on this call are going to be aware of this. Let's say you have an $800,000 practice. The selling dentist will get about $600,000 to $800,000, depending on the value of that practice, and the dentist will walk away in about 2 months. Sometimes it can be 6. You can sell 100% to a DSO. A good example of this is a Heartland transaction, right? Sell 100% of your practice. Let's say your practice is doing $1 million. You get 800 to $1 million on the valuation. Typically, it's closer to 800 for a Heartland deal. At closing, the selling dentist will receive about 640 to 800,000. About 160 to 200,000 will be held back over a specified period, typically 3 years. Although some of the DSOs are changing that work back requirement. Or you can sell a majority of your business and hold an equity percentage with a DSO like I've been talking about. Let's say you have a $1.5 million practice. The selling dentist could get 1.5 to 1.75 in the valuation. So the valuations are far more attractive. Again, depends on the office and location, demographics, and profitability. At closing, the seller gets 1.2 to 1.4 in cash, and then 300 to 350 gets placed into equity. That equity position at a recapitalization event can sometimes become 2 to 3 times its original book value. And if you, like I mentioned several slides back, if you want to roll that equity into successive recaps, you can do that as well, and that becomes very attractive to dentists. So how do you know what the best DSO option is? It's a serious endeavor, but here's what you should be considering, among other things. How long do you plan to work? What is your commitment going to be? What is the alignment between the DSO and your people of your organization? I've touched on the mission and vision of the DSO. That's very important. But how will that DSO interfere or get involved in the operations of your business? How will they support you? What infrastructure does the DSO have? How mature are they? And I'll touch on this last point because I know we're taking a lot of time. What is the total deal windfall? It's always important to understand via the structure of your deal with the DSO, what am I getting at the end of this? I know how much I'm getting in cash, but after this relationship and this marriage together, what am I getting? So this, to close this out and open up for questions, I did want to throw in that there's a new option that I am putting together. I hate to do this as a plug, but I want everybody on the call to be aware of this. There's a new option that I'm calling the Chinese American Collective. I spent plenty of time working under private equity and knowing what they're about. I've built 2 DSOs. I understand the struggles that one has to go through in doing so, and I know how the DSOs think, and I know how buyers think. And what I see as a huge opportunity is a way for us to collectively come together under this roll-up, right, under this collective, and we will select an initial group of high-performing dentists where we're all aligned on what we want to do together, where you can participate in what DSOs are doing without having to sell out to an existing DSO, and where you can have a say in the growth of your organization among a culture of people where there's alignment, where there's a shared belief system, value system, everything. And this is a rare opportunity for dentists who have been resisting DSO affiliation, in my opinion, and want to achieve it without losing control of what they've built. And that's something that we can definitely talk about offline or when I conclude the presentation. But let me leave everybody with an idea here, a financial projection, let's say. I've been working with a VC analyst of mine, a venture capital analyst that works for me. And we've been putting together a very complex model that I'm happy to go into at a later time. But let's say you have a practice or group of practices that are pushing about 1 million of EBITDA, 1 million of cash flow, as I was saying before. And that practice was valued at 6 million. And I'm not saying that this is the valuation for someone's practice. If it's doing 1 million, there's a lot of factors and variables there. But with what I'm putting together, the opportunity for the selling dentists and group can be north of 11 million. And my number is much higher because those initial entrants, that initial group, will actually partake in the actual funds compensation. It's quote unquote carried interest. And I'm putting that together only for those special entrants who are coming in the beginning. So whereas you might be able to go to the open market and sell for a 6 times, the implied purchase multiple at year 5 exiting is really more like an 11. So this isn't a promise of anything. This isn't me saying this is exactly what I can get your particular practice, but this is also an illustration of the power of what private equity can do if you get in at the right time and you join with the right partner. So that's my presentation, everybody. I appreciate everybody taking the time. I'd love to open it up for questions, and I hope I got through that in time. I know it's Sunday night.
Yeah, Michael, I have a question.
Yes.
You just mentioned if the clinic have multiple associate, so the price is going to be better. Why? As I see, the associate can leave anytime, right?
Right. That is true. However, from a risk perspective, the more associates you have working, right, the more you've widened or cast your net, so to speak. You'd have to have everybody leave instead of one for your business to go down the tubes. Does that make sense?
Yeah, that's true.
Right. So if I buy a practice that has one associate, in fact, there are a lot of DSOs that are actually moving away from making strong offers, and they're putting in risk adjustments into their purchase prices and structures. Because if that one doctor leaves, the entire business goes under. The key man risk is much higher. But the key man risk is spread when you have multiple associates.
Okay. Let's see if the clinic right now only have the owner practice right now. So if the EBITDA like 1 million, so usually this kind of case supposed to be multiple, like by 7.5 or 6 or 5. What's the multiple rate? What's the rate for multiplies?
Well, I'm not sure I understand your question, and I do apologize. I would tell you that the valuation multiple that is applied is going to be based on many different factors, right? So what's going to typically happen is, let's say I was buying a practice, I'd be looking at multiple things before I say this particular practice is going to be worth X amount, right? I was just using that 6X as for illustrative purposes to kind of give you guys an idea. In fact, $1 million practice may trade even higher than that number that I just used, right? But I was using it just for illustration.
Okay.
If you have strong profitability and you have multiple associates and you're in a very good demographic, you're getting a lot of new patients, if your marketing is optimized, if your culture is good, if your retention strategies are good, you're going to command a very good multiple, regardless of what EBITDA you're pushing off. Does that answer your question?
Yes. Yeah.
Mike, how dentist compensation is factored into the EBITDA, because since mostly it's kind of private, right, practice. Yes. So the dentist itself is you can pay themselves, whatever they think is the best, right, way to avoid tax or something, right?
Yeah. So once you, and I think I know where you're going with this directionally, but once you sell your practice, you lose obviously some of those tax advantages. right? Like,
Right.
you have your own business, you can run everything through it. And believe me, I've seen it all, right? So that is the beauty of having your own business. But when they're calculating the EBITDA, what they're essentially coming up with is, if I'm going to pay the dentist fair market X percentage on their adjusted collections, what does that EBITDA number now look like after I paid the dentist or
I see.
dentist? Yes. So typically the arrangement will be they're going to pay you anywhere between, Heartland's really on the low end, but I'll just give you the range. It could be like 28 to 32% of adjusted collections. If you're a specialist, those schemes typically change. I've seen schemes where it's 40%. I've seen some where of adjusted collections, I've seen some where it's all costs off the top and then it's 50-50. I've seen others where you've been able to get the specialist at 35%, believe it or not, right? But there are certain things being taken care of. So it all really depends.
Okay, thanks. Yeah.
You're welcome.
Hi, Michael. My question is, you said will be exit in a 3 or 5 or 7 years. Are you going to sell them to which one is a high valuation? So that's why we can get, the rest of the money after you sell. So I'm just wonder if that practice is get so high of the value, who going to be take the last ball?
I'm trying to follow. If you're talking about the Chinese American collective that I'd like to put together, and I'm collecting indications of interest on, yes, if I'm following you, the way that it works is that we purchase at fair market value what the individual practices are. But then when we go to sell, I'm allowing those dentists to partake in that multiple. And this is another sort of discussion for those that are interested. I'm allowing them to partake in that multiple in a way that other private equity firms are not, including participating in the actual fund itself. But yes, generally speaking, the idea is that is only happening to the benefit of the dentist because we're able to grow and scale and increase the exit multiple. Was that your question? Am I answering it properly?
Yes. My question, you almost answered.
Okay.
But my question is like, we will resell them where the exit time is arrived, or we don't have to sell them and we can keep them. Or I'm just say if the price goes so high, you have so much profit, and it's who going to come in to buy it? That's my question.
Yeah, so the choice to sell would rest with me and the firm, but obviously would be discussed with the dentist, right? But that decision would be made, and it would be made so you wouldn't be able to just opt out, right? Once you're in, right?
Right, but the PE money only going to be there for like 3-5 years. If their PE money is, the term is arrived, they have to take off the cash. Is that they already earned enough so they can just from the cash they can take over, and that dentists still have the share, or they have to buy back the share? So that's my question too.
Yeah, no, that's a whole other complicated, I may have, I don't want to complicate things, right? I think what you're asking is from the investor or limited partners perspective, what's going on with them. That's something I negotiate, and the terms I negotiate are not within 3 to 5 years. So there's no return of capital, so to speak, to them in such a short period of time. It's much longer, and that's another conversation for another time. But the way that it works is they obviously get a return on their money invested plus a preferred rate of return, and then profits are shared, right? Does that answer your question?
Okay. I thinking that's maybe later on to discuss.
Okay.
Yeah. Okay.
Sorry, if I couldn't properly answer it, I apologize. it's a lot more complicated, right? But it doesn't dictate when I should sell. When I sell, it's based on what is the highest value for the dentists that are part of this, and how does it benefit them in the long run, right? Because if I sell in 5 years and I have young dentists, let's say, well, those dentists are going to want to partake in another recapitalization event, right? In 3
Yes.
to 5 years. So I need to make sure that the deal that's being made is taking that into consideration.
DSO offered.
Yeah. Okay.
Right.
I think the question really is, for example, if you purchase the office for $1 million and 3 to 5 years later, this office grows to 5 million. And at that time, your investor said, we made enough money, we want to get out. And who is going to be able to put down the $5 million and purchase that practice at the time?
Well, yeah, great question. So, but there's two real questions in there. One is the limited partners aren't dictating, the investors aren't dictating when to sell. That's what I've got to make very, very clear. So there's not a scenario where it's like we've made enough money and we've got to get out, because the mechanisms to make that happen have to be based on fundamentally what's the best decision for the DSO and for the dentist, because they're also investors too, right? Like they're investors rolling an equity interest in a partnership model. So that there's no situation where that's being dictated. And to your other part of your question, what happens to that $1 million practice if it grows to 5 million? It's not going to grow to 5 million, right? It's that $1 million practice is worth a multiple because the collective has come together, and that effort of developing that business is something that the firm does, right? They go out, they market. In this case, it's me, right? Marketing and developing the business like I did over the last couple of years. Does that answer your question?
Not really. I'm just
Okay.
saying when the market, when it's time for example, for the participating dentist is ready to get out, let's say 5 to 7 years later, the dentist wants to retire, or even the investor wants to get out as well. At some point, when this business is going back on the market again, who is going to be able to afford to buy?
Oh, great question. That is the trend. So first, again, I want to clarify. The investor doesn't dictate whether there's a sale. If you wanted to retire in 5 years, but we didn't sell in 5 years, you can exit and take the equity, the book value equity that you have, but you would forego the recapitalization event. So what typically happens is you target a 5-year exit, but if we were to exit in 6 years, I'd be coming to the dentist and saying, hey, let's hold on because in year 6, we're going to be able to recapitalize. The other part of your question is who's going to have the money? There's a lot of money out there. That's what the private equity firms are looking for these platforms to hold. They're very attractive. It's happening all the time in the space. And the endeavor that I have is, and this may or may not be appropriate for today's conversation, but the endeavor that I have is I think I can build something extremely unique and culturally aligned that is even more attractive, thereby not just guaranteeing that it gets bought, right, and recaps, but the doctors get the highest multiple at that exit point. Does that answer your question?
Yes.
Okay.
Hello, Michael.
Hi.
How are you?
Good. How are you?
Good. So I have a question about what type of a dental office that DSO are interested in purchase. For example, Dr. Zhang is very skillful and experienced dentist. He has let's say 2 million production dental office.
Yep.
And I am a new dentist, relatively new, maybe 10 years experience in dentistry. And my patient base is quite simple, like a bread and butter dentistry. And
GP?
Dr. Zhang, for example, he's more like a specialist. He has a patient base not as large as mine, but
Yep.
he produced a lot. So in such a case, for DSOs, which office they like to purchase and in what way, in which way?
Yeah, that's, and may I call you Lei? Because it's coming up as Lei Fu.
Yes.
I don't know.
Yes.
Okay. So Lei, really tough question for me to answer for you. I can tell you at a very high level that whether you're specialty or GP, it really depends on the type of DSO. There are DSOs that focus strictly on specialty. There are DSOs that focus on multi-specialty, right? They'll buy multiple specialties. Some are GP and specialty focused, and some are only GP, right? So it all depends on the DSO. There are also DSOs that are structured in such a way that they'll roll anything up as long as there's just doctor alignment. And there are risks associated with that as well, right? Risks both to the doctor as well as to the platform. That's where really the advisory comes in, is that if you are thinking of transitioning, right, you've got to be able to weed through all these finer nuances in the deal. But how they value the practice is going to be different one DSO to the next. And let me give you an example of this. There's always a game that is played by the buyer, right, by the DSO, in my experience, my personal experience, where, you know, they play a game with the operating costs and they arrive at, you know, an EBITDA number that may not be the real EBITDA number. That's why you need someone, and again, it's not a plug-in for me, I'm just speaking generally here. You need someone that can help you understand what your real EBITDA number is and not budge from it, right, in order to get the most value for your practice. That's the first thing. Then you got to think about the structural considerations, as I was talking about in previous slides. Some of those structural considerations are going to be, well, how much equity am I really going to want to put into the deal? And how much equity does the DSO allow? Some DSOs only allow you to put 10% equity in. Some are strict at 20. Some are strict at 40. Some are fairly flexible, right? Some will have you roll that equity into an operating company, or some will have you roll it into the holding company, all of which have different effects, not just on the outcome of your investment, but different effects on how you're motivated as a dentist and what your deal is going to look like. Does that answer your question, Lei?
Yes. So as a GP, I'm always worried as my skill level and experience accumulated and my patient base expand. At a certain time when I want to get out the daily dentistry, meaning chairside dentistry, it's quite hard to find a successor or an associate to take over the practice, because that takes years of continued education and dedication in excellence of patient care. That also sometimes put the practice in a position that DSOs will look at it.
I just lost you, Lei.
And that leads to loss of patient, which is the main thing. And when that happens, the doctor, for example, will not get the equity that they're planning or scheduled to get. I don't know if that makes sense to you.
Well, Lei, I lost you up until the point where you were saying you could something about the associate, and then see what is the risk? Because you broke up for a second. It was the risk was
to find a proper GP. I know it.
Right.
Replace a existing specialty office doctor. But
sort of
when it comes to
please.
GP, because general dentistry really has a large and wide spectrum of dentistry, and over the years, the dental office have seen a large base of patients that they may come from different age groups or different dental needs. So how do you maintain that patient base when you do the practice transition to a new doctor and with DSOs?
Systems.
And that will not affect the equity or the purchase price of the practice.
Well, so a couple things. If you're already purchased by a DSO at that point, they have a system to do it. But as far as maintaining your own patient base, if you're bringing in an associate, it all comes down to systems and execution. So you have to have good operational systems, you have to have good communication, and you have to be able to phase that transition in a certain way. I mean, the way that you do it is also, again, dependent on the practice and the type of associate. You've got to put a plan together to do that properly. But you're typically, if you have an associate coming in and they're buying in, let's say, or they're eventually coming in to transition you out, there are defined systems and processes where you can do that and significantly minimize any patient loss. You may lose some, but you're not going to lose it to where it's damaging, right? And as far as patient retention is concerned, even if I put a new associate in, and this depends, it's different fee-for-service practices versus in-network practices, and this is all stuff I can go down multiple rabbit holes. But generally, if you're providing a standardized, strong patient experience program and you're measuring it, even after you do that transition, you're going to maintain your patient base.
Correct.
Hello, Michael.
Yes.
I have another question still regarding about the associate part. Actually, currently, I'm in the processing to negotiate with a DSO. Actually, I lost my associate during COVID-19. How can I get the negotiation power? Because right now, I only open 3 days, but my production goes up a lot. And I can see in the future, actually every year is going up. So, but one thing is I lose my associate. What I'm wondering, actually why I want to join to DSOs is because they're supposed to help me to find the administration part, like hiring, marketing. I think my practice is gonna have more potential if I join DSO. That's what I want to tell. Like when I negotiate with the DSO, I will see. Right now, I only open 3 days. That means I have more potential. So if I join with you, you can find more associate. We can make more, profit. And actually, they will make profit because the associate will make money for them, right? I just take my commission. So I don't know. You mentioned DSO prefer have more associate, but if they have the clinic without the associate, but I only like open 3 days, then they're supposed to have more potential, right? So that means they're supposed to like to buy this kind of practice. That's what from my side. So my opinion like that. So I don't know, am I wrong or something tricky in your side? You can analyze the situation.
I mean, I would feel far more comfortable analyzing your situation because to answer that question, there are multiple factors. I don't know if the DSO is taking advantage of you. I don't know if I know what I would do. I put 90 million of deal flow through to an investment committee just over the last couple of years. So I've seen hundreds of millions of dollars worth of deals. I can tell you exactly what a DSO is going to do. And I don't know if it will benefit you. It may, but it's going to be dependent on multiple situations. Now, you mentioned partnering with me for a second, but I don't think you really meant me, right? I think you meant more of a DSO, but that's where I think I'm different in the sense, just to plug in here, right? What I'm offering, I think, is something far more equitable than other DSOs. And I know it because I know what they do. But if you've lost your associate, your EBITDA will go down, generally speaking, which means whatever valuation they're going to put on it is going to be lower. And I think you mentioned this already, but they may or may not be able to actually find you an associate. It depends on who the DSO is, what their geographical representation is, how much market share they have. And then the real question is, how well they're going to be able to help you with those sort of back office and administrative functions. That's the real question, right? You're making the assumption they are, but they may or may not be able to.
But the thing is, I lost my associate, but my production goes up and EBITDA goes up also. So that's what I'm wondering. And I think I should have more power to negotiate, right? Because it's going
in that
up.
case, yes.
Okay.
In that case, if your EBITDA is going up, you will have more power to negotiate. But what's going to happen is you're going to want to negotiate in that particular situation. Again, I'm saying this without having analyzed your practice or your business, right? But there are some unique things that you can do to negotiate more over future years, right?
Okay.
So that's what I'm saying. And I've done this, right? When I've put together certain deals, but I don't know anything about your practice to be able to tell you how to negotiate that and what to negotiate from a numbers perspective. But in theory, you should be able to do that depending on who the DSO is and all that good stuff.
Okay. Is there any way, like, as I heard, like some people, the production every year goes up now, so they have some way, like, have you ever heard about like the ground bonus? Grand bonus. I don't know. It's a French name. It's a grand bonus. That means after year, you recalculate EBITDA, so you can make more difference. Like if I closing a deal this year, so next year my EBITDA goes up again. So they will reevaluate. Is there any way like this way to?
Yes.
When we okay.
Do you have? That is.
Yeah.
No, go ahead. Sorry.
Do you have any other way? Just try to compensate the when we close the deal. Try to make a good closing, like, because I think in the future I can make more and more. Even after we find a new associate, like we try to open 5 days or maybe 7 days, whatever. So then gonna have more and more and potential. So should I do something? Do you have any trick, like make more good deal, like for the potential part?
Yeah, I mean, again, it's hard for me. I'm very capable and talented at the negotiation stuff. I'm not here to. I'm not really trying to sell myself per se. But what I would tell you is, it's hard. It's hard for me to say to you what I can do for you without knowing the fundamentals of the business, right? But generally speaking, yeah, if you're going to go negotiate with with a DSO, you should have somebody by your side doing that and looking at every angle to squeeze every penny out of the deal. Like, I don't know for sure right now on your deal, and I don't think you want to say it over this webinar, but I don't know how much equity, how much cash compensation there is. If there's an EBITDA revaluation, what are you getting on the EBITDA revaluation? What happens if you're working more days versus less days, how they're compensating you for that? Is there a long-term incentive plan for you or any additional bonus system for you? I don't know any of that because I don't know. I don't have enough context, right? But the answer to your question generally is, yes, you can definitely get more aggressive with them. Plus, I don't know the DSO either. The DSO may be a strong DSO and they might be a weak DSO. I couldn't tell you.
Okay. Can I ask you after the webinar some detailed things?
Sure. Yes. Okay. I mean, what I would say is, because it is getting kind of late, it's okay, right? If you like to call me, but we can also schedule a time. I'm happy to talk with you about it.
Oh, super. Thank you. Thank you so much.
No
the second question is regarding about like, how do you think the percentage of the ownership once I closing the deal? They offer me 20% and also another 10% in the whole company. Like for the DSO, the whole company. How do you think this, the pie like this divided?
Again, hard for me to say because I don't understand the economics of the deal or your practice or the DSO. That's what I'm saying. I mean, it's pretty standard to give an equity position in a partnership, and it's definitely okay to have an equity role in holding company versus the actual DSO, but I know nothing about the org structure. I know nothing about their holding company. I don't know anything about their projections, and I don't know fundamentally anything about your practice. So I'm happy to
Okay.
go over all that with you and give you some advice on it.
Okay, then I'm gonna call you later then.
Sure, no problem. Yeah, you could call me
Okay.
right after the webinar if you'd like. Yeah.
Okay, thank you so much.
You're welcome. Sure.
Hey, Michael.
Yes.
Thanks for the presentation. I have a question is, if you become, like I saw, any dentist sell the office to a DSO organization.
Yes.
Since all the private practice dentists, 10 years, 20 years, or 30 years in the business, they are kind of play the role decision-making person. So after they join the DSO, become like a partner.
Yeah.
How do you have experience with all the dentists struggling to get used to that kind of position? Like who's making all the decision? Who's quote unquote boss? You know, to all the staff, all the
Yeah.
where they're going. So that's, I think the probably is to make a lot of dentists hold on or kind of pull back because of that. I don't know, you have all experience with that.
Yeah, no, I never had any experiences, any problems, significant ones, right? That weren't something that I couldn't take care of through coaching or counsel. Ultimately, at the end of the day, and is it okay if I call you Jit? That's the what's coming up here.
Yeah.
Okay. So, you know, I never really had any issues with that. First of all, from a decision-making standpoint, and I think you're asking how I would do it, so I'm going to answer from my perspective, right?
Okay.
But it's very important in a partnership, right, that you set the right expectations in the beginning and you actually deliver on those expectations. It's one of the reasons why I'm so passionate about raising my own capital and doing this myself as opposed to going the private equity route, because typically when private equity gets involved, you know, with their traditional way of doing things, they end up screwing the pooch. And so, especially for early startups. And that's not completely true all the time, but generally, right? You just got to find the right partner. But I would say that the clinical decisions are always 110% made by the dentist. 110%, no exception. I do not get involved, nor should any DSO get involved in that, right? Now, there can be some execution by proxy or decision-making by proxy, meaning you have somebody that, you know, is working on your behalf under your guidance from a clinical perspective, right? But generally, it's all made by the dentist. But what I do with my dental partners is I sit down with them and we actually level set on, well, what do you want to have control over and what do you not want to have control over? What are those left and right limits? And once that is set, that is what we agree upon doing. Now, if there are challenges with things being done effectively, well, then I come to you as a partner and we just have a very conversation. Nobody knows about it, right? It's just you and me, we're partners. And I just talk to you about, hey, look, what can we figure out to do a little bit better here if it's a problem? That's only if it's a problem. But generally speaking, I have found that the alignment that you create with the dentist, especially with the way I'm creating it, where there's such a significant participation in the equity, it's not limited, and the early adopters are able to actually participate in the fund's interest, in that carried interest, which is even bigger. That alignment typically drives a cohesive relationship and one that's free of problems anyway, because we're all working towards the same thing, right? So it's all about, in the beginning, it's all about setting the right expectations and understanding what left and right limits are, meaning here's what I want to do, here's what I don't want to do, and then delivering on that. It's actually quite simple, right? Where problems come about is when a partner just reneges or goes back on that kind of stuff. Does that make sense?
Yeah, yeah. So good. That answered my question. Another thing, if you have a few associates, and for years, my associates, some associates stay with me for more than 20 years.
Yep.
That means something probably I doing something right. But if from a point of view of the DSO, you take over, of course, DSO, everybody want to make a profit. Is there any, have you ever experienced something under the DSO prospect? You change things, how you pay associate or other staff. I have a lot of staff, 20-something years, almost 30 years with me. So how do you pay them? You know, how do you take care of them? Like a holiday or whatever. If you change them, have you ever experienced some DSO like push people out of the door? And then you still feel bad. You know, see all the people with you for so many, many years. And just suddenly, you just talk about the culture, practice the culture. Probably every practice has their own culture. How do you unify them? How do you make like the culture or respect each individual practice culture environment?
This is a great question, and I could talk about this for hours, Jit. But I would say
another time then.
No. I don't want. I'm just saying it's actually an area I'm very passionate. So I'll give you some background. I have a background in human capital, and I partner with a human capital management company that does some very specific work in helping improve cultures in dental offices. And I would tell you that where DSOs in general that you're mentioning go wrong is that when they're managing change or they're coming in and acquiring the practice, especially during the first 100 days, what they'll do is they'll come in and they'll institute changes they think work for the organization, but they don't know how they're going to work for the uniqueness of the people. So to your point, Jit, if you've got somebody who's been working with you for 10, 20 years, in my DSO that I'll be creating, there are no changes made whatsoever to compensation. And frankly, very little done to interfere with the operations of your business outside of support. And there's a defined process that we would take to help make sure that that change is managed in a way that pays attention to the needs of the uniqueness of your people and the culture of your office. I do not come in and reduce their pay. I don't change their positions. I certainly don't reduce or change the associates' compensation, because that is all built in already to the financial projections and how we value the business, right? So the DSOs that mess it up, and this is why Harvard publishes in its, Harvard Business Review, HBR, this is an article probably 30 years old on this, on why 60% of M&A transactions fail. Well, they fail because the human element hasn't been taken into account. In my opinion, it's not just the human element, it's the cultural element. Private equity firms employ people that sometimes just will not meld or jive with the people of a dental office. And you've got to know that. And so I just have had the fortunate opportunity of working in dental offices, so I understand some of the unique cultural mores and can use that to my advantage. But under no circumstances would I ever make a change, or should a DSO ever make a change to fundamental things such as pay or compensation or benefits that negatively benefit the people of the organization, because then they do actually leave on you. And that does happen.
Okay. Sorry, I take a little more time, but one more question, just the last question, one more question.
Sure.
After you take over, or DSO take over, become like a partnership, the owner or seller dentist or the team with the associate has to take more. I heard that they take being pushed harder, extra effort, because everybody, of course, everybody want to grow more and benefit everybody. But sometimes I heard people being pushed over the edge. They feel it's too much, to satisfy after the joint venture. They feel like it's too much. So I don't know. This is the kind of pro and con you heard from a DSO. I'm not sure you have any explanation on that part.
Yeah, it happens. And it happens in a lot of the big DSOs. I can tell you, I know it happens at big ones like PDS and typically to associates that are new grads coming in. I think it's unethical. First of all, telling an associate to produce more just isn't possible because the production has a direct correlation with how they're diagnosing, and how they're diagnosing is 100% a clinical endeavor and is something that's the doctor's decision. So, you know, I certainly don't do this, and I do frown upon other DSOs that do. And this is why it's so important that when you're going to sell, that these questions are asked, that, you know, and there are ways of asking the question without actually asking the question to know if the DSO is BSing you. And there are ways of conducting diligence if you're going to sell to a DSO to make sure that that doesn't happen, right? But any DSO that does it, and when they do, they're crossing a red line, it will cause turnover issues of the associate. It's unethical and shouldn't happen. I don't condone it, and I have never done it, nor will I do it in any DSO endeavor.
Okay, good. Thank you.
Yeah,
Thank you.
you're welcome. You're welcome. Nice to talk to you, Jit.
Okay, thank you.
Hey, thank you, Michael. I really appreciate that your knowledge and all that sharing. So I'm very glad I introduced you to the group.
Thank you, Stephen.
And you retain all the all the people audiences even at this time. It's kind of late. You know, I have a question for you, for myself.
Sure. Go
So
for it.
I did a lot of specialty service, right? So would a DSO interested people like me, dentists like me?
There are some,
Fine.
yes. There are some. You just got to be, again, I say this, right? Got to be careful on who you align with and what the structure looks like, but there are some, yes.
Yeah,
Absolutely.
because I'm thinking myself, if I'm leaving the practice probably would worth not a lot of things, not a lot of money.
Right.
But if because I'm the one practicing, making a lot of profit money. But
Yep.
if I leave, they're probably not worth that much, or not at all,
Yeah.
either, because yeah.
Key man risk is high, Stephen. Yeah.
Okay. And the second question is, do you have any kind of a gambling agreement put into your strategy, like Chinese we say 对赌协议? So you promise at the end of the year, 5-year exit, you promise those dentists who you purchase, certain amount of millions, but if you don't deliver that, would you compensate for that loss? Stupid question, but
no, it wouldn't be a compensation for any possible opportunity, but it would definitely be compensation for the valuation. So in other words, it's kind of hard to answer that question, right? Because everything is everything's contingent upon, what's happening in the marketplace. Like there are multiple variables, but to answer your question, Stephen, the likelihood, if there's a way of going about this, which I can't detail right now over this webinar, but for those that are interested, if we all get together and have another call and they're super interested in doing this, there's a way of doing this that significantly reduces the likelihood of failure to like almost nothing. I can never put a guarantee, because if, like, for instance, in my projection of only for those entrants, right, getting, let's say, an 11 times, which is amazing. If we do this the right way and there's the right kind of alignment between the dentists, it's hard for that not to work out. It really is. Because the market is so hot, it's consolidating so fast. Everybody just needs to be aligned, right? If you drive the right alignment, success is there.
Absolutely. Thank you.
Sure. Thank you.
Can I ask you a question?
Sure.
You mentioned about different type of DSO. How do we find which type of
which DSO to choose from,
There is no, this is Jessica. Yeah, Jessica, first of all, nice to meet you. There is no hard and fast like A, B, and C on choosing the right DSO, right? That's again where I would advise you, right? It depends on the type of practice you have, what your goals are, what you're trying to achieve, what your personal financial situation is. There are so many factors in trying to figure out which DSO is going to be right for you. It's like saying, I worked at Merrill Lynch for a few years. I helped manage a portfolio, very large portfolio. And, it's like saying, well, how do you pick the right financial advisor? There are a lot of financial advisors, right? But ultimately, at the end of the day, you've got to find one that you believe is competent, and you've got to find one that you believe is able to deliver on the goals that you're going to have over a period of time. With a DSO turning over your business, which you've built over a number of years, that is highly successful. If they want you, you want to be able to, you want to make sure that they've got your back and they've negotiated the right kind of deal for you. You believe in the same vision that they have. They're going to support your interests and protect you. And it comes down to a lot of quantitative and a lot of qualitative, Jessica.
Yeah, that's why. How do you choose which one to pick?
Well, that's what I'm saying. I
Yeah.
choose based on the uniqueness of my client and what my client needs. Right. So it's funny, right? Every dental practice is different. Every dentist is different. Their needs are different. And there are some similarities, right? Like I was speaking about before, how much debt they carry, those types of things, right? Like some dentists have, a lot of school debt. Some don't have a lot of school debt. Some have a lot of equipment debt. Some don't have any equipment debt, right? But, it all depends on the uniqueness of the dentist.
Okay. For practice whose revenue less than 750.
Yep.
What's other exit strategy? What's the best way to exit?
Yeah, if you're less than 750,000, well, a couple things. One is I spoke about that unique option, which is, I think, for some dentists that have practices of that size, there's a way where you don't have to sell it. You can still make money on it over a certain number of years. There's a 2-year planning process for that. It doesn't work for every dentist or practice, but there's that option. There's a second option too, which is extremely normal, like very common in the marketplace, which is you can just bring an associate in, ramp down your production over a period of time and sell it to an associate, or you can sell it and walk away. Those are typically your options. I favor the dental annuity because you can cash flow on it almost like a hard asset, like a real estate asset. And you put the right administrative team in that reports to you, you still own the asset. And if you want to sell it, you can still sell it and get the cash then. But the value, the total value of all those cash flows over however many years you held it, plus the final sale is always typically going to be better than if you just sold it and walked away.
Thank you.
You're welcome, Jessica.
Mhm.
Hi, Michael. I have a couple questions. It's
Yes.
you said the dental annuity. Does that mean you is that the same thing as you hire something like a professional, like a management company, to help you to improve the profit, and then to a certain amount, then you sell it?
Yeah, it's like that, but I'm actually the professional management company that does it, right? And I invented the dental annuity. But the way that it works is we provide the financial projections for you on exactly how much you're going to cash flow after all infrastructure costs are built in, and we work with you on a designed plan to get the people that you need in there, including associates, if you need associates, so you're essentially hiring an administrator at a fee to keep your business going. Right?
Okay.
But professionally done, and you know exactly what your range of cash flows are going to look like on a monthly and annual basis, and then we can run the calculation swang on what it looks like if you were to exit in 3 years, 5 years, or hold it for 10 years.
Okay, I understand. That actually is will bring me to my the same thing as my second question to you, because all through your lecture you mentioned there is this is one way you can get involved. Another way is from your business card you get advisory, you can do the consulting. Another way you mentioned the Chinese collective, the group or whatever. It's if we want to get a connection with you. Could you give me a brief summary? What the kind of option we can get involved? You can get involved other than this annuity. How to do the Chinese collective?
Yeah, the purpose of today's call, among other things, I wanted to be as informative as possible, and obviously represent positively my relationship with Dr. Shui, which I value very, very much. Let everybody know, of course, what Bannockburn Advisory does, but the fund that's being put together and the DSO that's being put together, really right at this point, we're collecting indications of interest. And then my job is really to find those key dentists, those top performing dentists that are going to drive the value that's needed and will be excellent representatives and stewards for the future platform that's going to be built out to 50, 60, 70 practices. But all of those dentists would engage in a partnership with me where they would roll their equity interest into an operating company, essentially. And then when we go to recap, they're allowed to take that recap and do what they like with it, reinvest it, take it. There is a work back requirement, right? Standard work back requirement of 5 years. And we would work together on that. But I think that it would be hugely powerful because the one thing that I do that I can guarantee on today's call is I will not interfere in your business in a way where your patients or your staff feel as if they're being interfered with. And given the nature of consolidation the way that it is, where you're going to have to compete against DSOs and they're going to be making phone calls, at least you can have a personal relationship with the guy at the top who's controlling it, as opposed to just being an add-on to this beast of a DSO that already exists. Does that answer your question?
Yes. It's I think it's a pretty good idea. It's because actually it's as a previous doctor's question. It's for the practice under the 700 something. It's actually I have multiple locations and there's several the associates. But my each location is relatively small, but very profitable. And actually, I'm looking how to grow bigger. So maybe your service with something like a management expertise, how to improve the profit margin more. As we're growing very fast. We're growing every year. It's the 20-30%. It's I think right now I feel like we need more like a management skill to improve it. So it's maybe this can bring some benefit for that.
Possibly. Yeah. I don't claim to know if it can or can't, but it wouldn't hurt to have a conversation. And I always look at things openly. There's obviously a wealth of expertise that I could give you. You're clearly successful, right? And having multiple locations. So my hat's off to you on that. But would love to discuss more with you and everybody, really, the initiative that I'm trying to put together with the Chinese American Collective, because I think it is so unique and so powerful that the dentists that want to join this will benefit significantly. Because no one has done this, and I'm trying to keep it quiet, right? Because no one's been able to figure this out. And I obviously have the expertise to know how to structure things properly, how to raise the capital, how to put everything together to benefit my partners. So it's definitely something we can talk about. Definitely.
Yeah. Another last question. Sorry, is because I do have a couple practice in a very good location. It's like a very affluent town, and for many years. But I see all my friends, the practicing dentists around us, and I don't see any space for any DSO can get in. I don't know, because the patient is so stay with their, they don't want to move to anywhere. And do you really think within the next 3 to 5 years or 5 to 7 years, there is really isn't any of the space for the private practice, especially in those urban or affluent area. The patient is very picky.
Well, the data and the conferences that I go to and the legal contacts that I have, for instance, I happen to know how the ADA collects its information on consolidation. I happen to know how some of the big consolidators measure their consolidation efforts. Over the next 5 to 7 years, well, let's put it more towards 7 years, and it'll tap out around 10. You're going to see the majority of the market having been consolidated. And what that means, so let's say greater than 75%. What that means, at least that's what projections have it at now. What that means is that it becomes a lot harder for you to compete from a new patient perspective, cost perspective, et cetera. So you can operate as a single practice. This is going to change the dynamic of how you practice is going to change, especially if you want to add associates, because their recruiting capabilities alone are extremely powerful. They're getting them not only right out of school with guaranteed pay, but they're also able to pay them some pretty significant bonuses to attract them with support systems, right? So that's where it becomes a lot more complicated as a single practice owner over time, and is a reason why, if you're going to make the decision to transact with a DSO, pick one that makes sense for you, make as much money as you can on it, and know that when you look back that you've been happy with that decision. That's at least my take on it.
Okay, I got it. All right, thank you very much, Mike.
You're welcome.
Dr. Zhang, Dr. Zhang, are you there? Dr. Zhang?
Yeah, I'm here.
Oh, you can close it. I think it's kind of late. Yeah.
Okay.
It's a wonderful lecture. Thank you.
Yeah. Thank you, Michael. Yeah, well, you are a wonderful lecture. Yeah, I learned a lot because I'm driving, so that's why I didn't ask any question.
Oh, that's okay.
I'm going to ask you privately. Okay, a lot of questions. Yeah.
Sure, absolutely. Please, feel free. Again, send me an email, call me, whatever. I won't bug anybody. I'm on WeChat. You can find me. I'm happy to help anybody in any way possible. I'm really passionate about this roll-up I'm putting together. And Dr. Shui and Dr. Zhang, thank you so much for the opportunity to present tonight.
Okay, thank you, everybody. Yeah.
All right.
You have a good day.
All right. Good night.
Good night. Bye.
Thank you.